This presentation is going to focus on the limitations associated with segregated funds. You can find this in 2.3 of your study notes. So if you are looking for more details, that is the place to go. As always, we're going to start off with those three things that will help you remember the pieces of this presentation. And those three things are charges or loads, fees, and investment risk. Risk to capital, so that is affiliated with the amount of money that your client has invested. And so with this, remember with the segregated fund, the funds are invested for the length of a set term. And it's really not meant to encourage early withdrawals. And so these guarantees that your client is paying for with their segregated fund do not apply to any early withdrawals. And so your client, if let's say, for example, their investment has decreased, they are just going to get the market value in. And if that insurance company does have any sort of sales charges affiliated with withdrawing your money early, they will have to pay those as well. So that is something to keep in mind. Remember, there's also that 25% of the capital that can be lost. The maturity of it, usually it's around 75%, the death or maturity guarantees. And so 25% of the capital is at risk. There are also age restrictions affiliated with segregated funds. RRSPs, age 71, as always for RRSPs, you can only put in money up until the end of the year that your client has turned 71, so December 31st. And after that seg fund needs to be converted into a RIF. RIF, age 90 is the last age for an authorized transfer, so something like a spousal rollover. And non-reg and TFSAs, deposits can only be made into these two types of accounts up until age 90. There can also be penalties associated with withdrawals and surrenders. It really does depend on the insurance company, so it's important to look back at that contract that your client has signed if they do decide that they need to withdraw or surrender money before the length of the term. Sales loads or charges are a one-time charge that the client makes in order, and basically this is the compensation that is paid to the agents or yourself. So this is how you are personally getting paid. And there are three different types of sales charges or loads. They're exactly the same as mutual funds. The first one is the front-end sales load, or the FEL, and that is a percentage that is paid on deposits. So those deposits might be just a one-time deposit, or you might have an ongoing pre-authorized or a checking or pre-authorized pack set up with your client that they're depositing into their account on a regular basis. It is really up to you and your client how that FEL is structured. This is a negotiable part of the contract, and it is something that you really need to make sure that you explain very clearly to your client. So they can have an initial deposit and an FEL is charged, or even each of those ongoing deposits and FEL is charged, or you only do one or the other. Like I said, it's negotiable. So let's say, for example, your client is investing $10K and you've agreed on a 5% FEL fee. That FEL is taken off of the initial deposit, off of the top. So $500 is paid to the insurance company, and then you as the you as the agent would receive some, if not all of that money. More than likely some of that money, because you're probably paying tax and other things that you owe to the insurance company. So the client is actually in that situation only investing $9,500 into their segregated fund. The next is DSC, so deferred sales charge. That is a decreasing charge over a set amount of time or set number of years. And that usually decreases every year up until it reaches zero. So let's say your client invests money, it is year zero, whatever that whatever that DSC fee is, usually might start around 5%. If they decide to take money out that same year, they will pay 5% on any withdrawal. And then this decreases every year up until usually around 6 or 7 years when it becomes zero. So let's say at year 3, they decide to take some money out. They'll be they'll have a DSC charge of anywhere between 5 and 0% in this example. Now, this is always clearly drawn up when you decide to have a DSC fee, and nothing is hidden, so your client will know exactly what those fees are. And it is important that you know as well, so that you can communicate that to them if they do decide that they want to take money out early. The point of the DSC is really to encourage your client to keep the money in for a longer period of time. And then last, there's the no load. So with a no load, there's no charge, but usually with this type of structure, the MER is a little bit higher than with an FEL or a DSC. The MER, or the management expense ratio, again, same thing for mutual funds. Both of the segregated funds and mutual funds both have MERs. The MER on a segregated fund tends to be higher than a mutual fund for the exact same product, and that's because there are quite a few guarantees that are affiliated with segregated funds that mutual funds do not have. So your client is really paying for that security. And the MER is a combination of several different things: the management fees, the operating expenses, which tend to be higher in a segregated fund. And those include sort of administrative costs, legal fees, marketing, commission paid up front to you as the advisor. Also, it does include the trailing commission. So as an advisor, you do get an ongoing trailing commission for your assets that are under management, which are paid quarterly to you. And that's sort of a sales compensation fee. So that is included in that MER. And the cost of, like I was saying, that higher bit, it really comes from the guarantees. So the cost of the maturity and death benefit guarantees. Seg funds have that 75% guarantee. And so the MER is higher because you're paying for those guarantees. Now, remember that an MER does reduce the investment return. So if your client is getting a 5%, your client's investment is getting a 5% out in the market, and the MER is 2%, they are only going to receive 3%. And so it is important to remember that, and regardless of whether the investment has increased or decreased, so whether it's had a positive or negative return, that MER does always come off the top before your client sees any returns. So that is something that is very important to understand and that you communicate to your client. There is a higher MER for more active funds and a lower MER for more passive funds. So things like, for example, an index, that is a lower, more passive investment, and so the MER will be lower. As always, it's really important, I've said it a couple times through this presentation, that you communicate clearly about the charges and fees that are affiliated with segregated funds. It's really important that your clients understand sort of the ins and outs and what they're all about, so that way they aren't caught off guard when they have to pay them. For more details, please check out 2.3 in your